Interest, APR, simple interest, compounding interest. What is that? Welcome back to our What is that series, where we describe financial terms and help break them down so they're easy to understand. Tiffany Gonzalez CPA here, founder and CEO of Accounting to Scale. Today, we're talking all things interest. So let's start right at the beginning. The definition of interest is the charge for the privilege of borrowing money. It's typically expressed as a percentage, as an annual percentage rate, also known as APR. Charging interest on money goes back to the Renaissance days. Once money had value and lending it had an opportunity cost, interest became commonplace. So what is simple interest? Simple interest is the percentage rate charged on a daily basis on your loan. It is calculated by taking the percentage rate multiplied by the principal balance of the loan, then multiplied by the days that have elapsed since your last payment. Compounding interest is typically known as interest on interest. It is called this because it is calculated by taking the same percentage rate, multiplying it by the same principal amount, but also including interest that has already previously accumulated. Compound interest is great for your savings account, but it is not good for your loans. So let's talk numbers. Let me give you a brief breakdown to better understand the difference between simple interest and compounding interest. Let's say you're depositing into a bank account $1,000, and that $1,000 is set to earn simple interest of 5% per year for the next 5 years. This means that at the end of year 1, you will have $1,050. At the end of year 2, you will have $1,100. Each year, your bank account will go up by $50 only because it is 5% on $1,000 every single year. With compound interest, taking the same example, 5% interest on a $1,000 deposit, your first year will be the same. You'll earn $50. Your second year, you will earn more money. You'll earn $5,250. Why? Because now you are earning 5% on the previous $1,050 from the prior year. And each year you'll earn a little bit more because now you're earning interest on your interest. So, taking the two examples, over 5 years with simple interest, you will have earned $250 in interest income. But in compounding interest, you will have earned $275. That's $25 more over 5 years using compounding interest. This large difference is the reason why you really want compounding interest in your savings accounts, but you don't want it on your loans. APR, annual percentage rate. What is that? And what's the difference between that and the interest rate? Essentially, they are almost the same thing. They are a percent that is charged to your loan. The difference between the two is that the APR, the annual percentage rate, accounts for all the costs included in the loan, things like origination costs and lender fees. That is why you sometimes see the APR just a little bit higher than the interest rate of your loan. When you are comparing lender to lender, you want to compare APRs. Why is that? One lender might have a smaller interest rate but a higher APR than another loan you're looking at. And that might be because their lending fees and their origination costs, those sneaky little costs, are higher. So while the interest rate might appear to be lower than the current offer you have, their APR might be much higher. So make sure you compare APRs when looking at different lenders. We hope you enjoyed this latest installment of What is that? Please like this video and subscribe to our YouTube channel so you can stay up to date with this amazing series we're putting out. Also, follow us on LinkedIn, Instagram, or Facebook at Accounting to Scale. Until the next video, your favorite CPA, Tiffany Gonzalez.